Tata Steel is in focus, especially after the numbers they've come out with and the China stimulus, which has been spoken about. The stock is gaining 3% in trade. I spoke with the management right after the results. Here's a slice of that chat.
So basically, if you look at it globally, the recovery in steel prices has been weaker than we thought, simply because the recovery in China has been weaker than we thought. When we were in the last quarter, that was Q4 of last year, the thinking was the Chinese recovery will be strong and hence steel prices will look up. But that's not what happened. As a consequence, international prices were soft, and that's had a pressure on margins. While the coking coal prices dropped, last quarter we had used coking coal which was bought the quarter before that. So actually the consumption cost was higher than in the previous quarter. Steel prices could not make up for that higher consumption cost, and hence margins dropped sequentially. As far as India is concerned, the demand has been reasonably strong. Auto industry is doing well. Construction has been not as great as we thought, but still not bad. So India numbers have been strong. If you look at the India numbers, we've had more than 4,000 crores of PAT. EBITDA on an underlying basis is over 14,000 rupees. With the one-offs, it's about 16,000 rupees per ton. In Europe, we've had challenges simply because in Netherlands, we have a blast furnace shutdown, which was planned. We have a blast furnace relining going on, actually. And we had guided last time that we will have 2 quarters where the production in Netherlands will be impacted. And that's why the Netherlands numbers have been weaker than normal. UK has always been a challenge when steel prices are not great, and that is what is reflected in the UK numbers. We've done obviously better than what most people thought, but worse than what we did the last quarter and last year this quarter.
Right. So I remember I was talking to you last quarter as well, and you had indicated that the early signs, given few issues, the early signs are that European business is actually likely to turn around if some conditions are met. Do you think those conditions are becoming clearer now, or one can't say right now on whether the worst for European business is over?
I think in some sense, you mean for Tata Steel, or you mean in general for Europe?
For Tata Steel, European operations, UK and Netherlands put together.
Yeah, no, so it's like this. What I meant when I said last time that the worst seems to be behind us, I was referring to the fact that the overhang of the Russia-Ukraine conflict, which had played out very strongly last year, was reducing because energy costs, which really shot up, started stabilizing, which is good for us from a cost point of view. And the auto industry was picking up in Europe. So overall, conditions were better than it was in the previous year. Internally for us, we had a blast furnace relining, as I mentioned, which was going to disrupt production in Netherlands. But overall, obviously, the energy prices, the electricity prices, the gas prices, etc., while it's settling down, we'll see the full benefits of it only in H2, because we also do a hedge on, we do a forward hedge. And so we are still carrying forward some of the hedges that we did maybe 2 or 3 quarters back. So we'll see the full benefit of the energy prices in the second half. And if the, Europe, EU is expected to grow better next year than this year. So we expect the economic activity to slowly pick up in the second half of the year. So we expect H2 to be much better than H1 for clear.
Right. So I wanted to scratch that point a little more. What are the key monitorables you are looking at right now? Macro indicators. China is trying to engineer, a kind of a saving plan for the economy domestically, but it is under pressure, and the data shows that talk of stimulus is also coming back on the table. Do you see, what exactly are you monitoring over there, which will tell you that with much more clarity how H2 are likely to pan out on prices?
So firstly, in China, we look at different sectors of the economy. Auto has been quite strong in China. I think they're back to selling and consuming, buying 2.5 million cars a month. So they're back on track on auto. But construction, which accounts for 60% of the steel consumption in China, is not yet recovered. And any stimulus that has been given is gone towards more completion of projects rather than starting new projects. So the property industry, the real estate market, which really drove a lot of the economy, is no longer where it was. And that is reflected in the fact that the consumption of steel in China is not really as strong as it was expected. The consequence of that has been that China, after a long time, has started exporting about 8 million tons of steel a month, which is a pretty high number. When we had big issues with China, that was in 2016, when they were exporting about 10 million tons a month. After that, for most of the last 5 years, it's been at 5 million tons a month, which is okay. The world can live with it. But over the last 2-3 months, it crossed 8 million for the first time after 2016. It's dropped last month to 7 million. I hope it drops further. If it comes back to 5 million level, I think steel prices will stabilize at $600 or higher. Whereas if they start exporting 8 million and 7 million as you're doing now, then steel prices will be in the $530 to $580 range. So that's where it is. So we always watch out for what's happening in the Chinese economy and what are the signals we can pick out of that. And a lag indicator is how is steel exports out of China, how high is it, and obviously that has an impact on steel prices.
Sir, just one word on the visibility, or what indicators are you looking to gauge demand in European side? How weak is? What is the extent of that weakness? Is it likely to worsen, or has it stabilized and gradually will start improving? What's the view over there on demand side?
I think among sectors, auto is still quite okay. I think our auto customers continue to buy as they did before. So auto is coming back on track. Construction activity is not so great, but there is an expectation that as and when the rebuild in Ukraine starts, that will give a fillip to a lot of economic activity in that region. What we are seeing is the high energy prices, high costs, etc., have impacted a lot of the mid-size and smaller companies quite a bit. So many of them may be our vendors, many of them may be our customers. So they are a bit fragile, and that has an impact on steel consumption as well. So overall, and of course, inflation is still persistent there. So central banks are increasing rates. Inflation is persistent because labor markets are tight, unemployment is low. So that is reflecting in a sticky higher inflation level, leading to central banks increasing interest rates. We expect the economic activity, the forecast is next year it will be much better than this year, because inflation would have settled and I think the rate hikes would have.
So one last word on your debt reduction status and roadmap.
So we started the year at 67,000 odd crores. We finished the first quarter at 71 because we had a number of the capital expenditures gone as planned. The EBITDAs were a bit lower than what we had thought. And on top of that, the creditors came down because the price of coal came down. So while the gross working capital remained the same, the net working capital has gone up a bit. But we stay committed to reduction, deleveraging. The goal we set ourselves about 3-4 years back is $1 billion a year. Apart from last year, we did it on all other years. In fact, did more than that in the previous years. Let's see how it goes. It's been a more challenging year than we had thought, but we certainly expect H2 to be much better than H1.